So as I tried to put this together, I struggled a little bit as to how much old ground to retread. So what you'll see is I teach this course or a similar course in sort of different ways for different groups kind of throughout the year. And so this is a little bit of some slides from there, some slides from the last time we were together, and so forth and so on. So you might be able to, so some of this stuff is going to look familiar, but hopefully this is still helpful for you guys. And I think the reason I brought it up is I think it's important to kind of go over all of this stuff. It's just insanely important to have a really good baseline. And that's kind of what my point is here today. So we're calling this the Financial Projections Workshop Part 2, which I actually consider a little bit more about financial literacy. Okay, and so the notion of financial literacy is just how much do you actually understand your business and the financial statements that go along with it. Financial statements can show what the health of a company is. And so how well versed are you in it? And so I'm going to take the time today to try to get you a little bit well versed in some of the stuff that's really important. Most of the stuff is going to be more critical for people in earlier stage companies. Obviously, as you get to a later stage company, things are a little bit different. So agenda, just a quick intro of myself. And then I want to kind of go back to the basics. We're going to spend a little bit of time back at it, right? Sort of core basic accounting 101 stuff, super unsexy, but critically important kind of things that I'd like to sort of focus on. And then we're going to talk a little bit about financial statements and, you know, sort of the holistic view of the financial statements. The first session that I had run was a little bit more on just the income statement, how you create an income statement, how you create a forward-looking forecast. This one's going to be a little bit more of a holistic view of what the balance sheet means, what does the income statement mean, cash flows, how those things all tie together. I'm going to do a little bit on sort of creating them, but I'm mostly focused on the assumptions to create. If you have seen my first session, you'll see that I spent a lot more time just kind of drilling down into the basics of revenues, expenses, you know, sort of that formula-driven income statement and how you populate that data. I want to focus a little bit more on the assumptions that go into it, because the reality is when people are reviewing your financial statements and they want answers, they want to extrapolate information from there, and you need to be able to discuss the information that's in it. Your income statement is a reflection of an amalgamation of a bunch of assumptions. And so the idea is you need to be versed in those assumptions. You can put $1 million of income for the month of September. That doesn't mean anything unless you can explain to me, where is it coming from? How are you getting it? What are the margins on that? Who did you sell it to? Who else are you selling it to? How many people stopped paying? All of those things, and we're going to start going through that stuff later on. And then the last thing I'm going to spend a lot of time on are sort of business metrics. These are off of your financial statements. They're never necessarily going to be shown on your actual financial statements, but these are the types of things that people that are evaluating your business are going to look at. Those are the underlying things that you need to understand. Those are the fundamentals in understanding whether or not you have a profitable, sustainable type of a business. Okay. So, quick on introductions of myself. So for those of you who don't know me, which is probably most of you, and I'm assuming you have some ties to the University of Maryland. My background is I'm a Maryland alum. I also work for the Clark family office. So if you know those big blue Clark construction signs all around, that's who we are. So I work for the family office of Jim Clark. We no longer own the construction company, but I do invest on behalf of the Clark family. And so like I said, I look at the whole world through this lens of venture capital because that is where I've been trained. And so we invest mostly in kind of tech-enabled businesses. I'm a trained CPA, though. I started my career at Arthur Andersen, which is why I have such a strong sort of financial background. Started in audit, and then from audit made my way into a startup company back in the raw days of the dot-com boom, and then made my way to Clark in 2004, and I've been doing venture investing since then. So That's my quick background. I was hoping we have a smaller group here, I think. I'm not sure if you guys want to do a quick intro of yourself, because that might be helpful for me. If you guys wouldn't mind, can I just call your name, and would you mind just giving me just a quick primer on yourself? I'm just going to go over the list based on sort of the order here, because I like small groups. I think that they're pretty helpful. So Darren, do you mind just giving me a quick background if you can unmute yourself?
Sure. I am at the University of Maryland. I'm the program leader for Ag Extension across the state. And I'm also a shareholder in a startup company that I started when I was back in Iowa, and it's still ongoing.
Great. Thank you. Peter? Peter, I think you're still on mute here. Okay. I think
Okay.
There we go.
Can you hear me now?
I gotcha.
My button disappeared somewhere. I'm with the Tech Transfer Office here at the University of Maryland. I'm Innovation Manager, Tech Transfer Manager.
Fantastic.
My background is startup and management consulting.
Okay, great. Thank you. Asfar, sorry.
Hi, yeah, I'm also with the Tech Transfer Office at UMD, UM Ventures. I'm an innovation manager as well, so I manage the portfolio of technologies that come out of the university.
Great, fantastic. Lindsay?
Hi, Lindsay Ryan. I'm the Venture Development Director for the University System of Maryland. And so College Park is one of the 12 universities.
Great.
Yeah, hoping to get even kind of firm up my grip on this type of stuff, and then use it to help the companies that I'm helping, and also potentially refer to them to any recordings or whatever as a resource as well.
Perfect, thank you. Lisa?
Oh, hi, I have my own company. It's called Innovative Capital Access, and similar to the last person who just spoke, I help, I'm a TERP alumni. You may recognize me from TERP and Tank Night, but I help entrepreneurs train them in the fine art of meeting investors, asking the right questions, and ultimately getting results. So I'm using it not so much to build my own business, but to help them build their business.
Fantastic. It is definitely a skill talking to people in the venture space. So we have our own vernacular.
Yes.
So hopefully I can help get you some information here.
Thank you, Jennifer.
Great, thank you. Menglin?
Hi, this is Meng Lin. I'm a visiting professor in atmospheric science, and I'm also a founder of our own startup, and our company just received the NSF SBIR, and I would like to learn the financial assessment. Thank you.
Great, fantastic. I will hopefully be able to help you out here too.
Thank you.
Sahil?
Yeah, hi everyone. My name is Sahil. So I'm a TERP alumni as well. I went to business school and I did finance and international business. I graduated back in 2011. Then I worked with Ernst & Young for a few years. And then a few years back, about 4 years back actually, I moved back to India, which is my home country, to work in sustainable development. I was working with an NGO, and then a few months back, I started my own startup in the agri-business space. And that's where financial modeling and financial statements and all these things come into play. I do remember some things from about 8 years ago from Smith School, but trying to get a refresher here in this webinar.
Okay. Fantastic. Good to have you. Sutayaji?
Yes, hi there. My name is Satsunaja. I'm a PhD in public health, my background, as well as a background in engineering. And so I'm in the process of starting a public health consulting firm that is wanting to leverage venture capital to address healthcare in underserved areas.
Great. Fantastic. Michael?
Okay, I'm sorry, my video is not on and it's not working for now, so we'll just have to deal with that. I'm a postdoc in the Department of Chemical and Biomolecular Engineering. So I'm trying to develop my startup for a product we have on anti-fouling coatings. Thank you.
Great. Thank you so much. Ali.
Yes. Hi, I'm a faculty at the University of Maryland. And by the way, I'm connecting via my phone, so that's why my video is off.
No problem.
So I'm a faculty at the university, and I'm helping a team. They are developing essentially a startup in the carpooling area. And so they are seeking VP funding and so forth. So that's why I'm interested in these topics.
Gotcha. Okay, perfect. All right, good. Well, it looks like a small group, so please don't be shy. If you have any questions, I have a limited amount of screen here that I can sort of see everybody's little picture here. So instead of just raising, I was originally just going to have you kind of like raise your hand or put a thumbs up or something. If you have a question, just throw it in the chat box because my chat box up. So I'm happy to sort of stop. Let's make this interactive. It's no fun for me to just sit here and drone on and on. You guys don't want to hear that. It's a small enough group that I can tailor some of the conversation. So if I hit on something and it's relevant to you, it's probably relevant to other folks too. So feel free to ask questions. That's what I'm here to do, is hopefully answer some questions for you guys. Okay. So stop me along the way. In my field of venture, we always sort of joke around that we're kind of, professional interrupters. It's kind of what we do. And so feel free to interrupt me. It's not going to offend me at all. Okay. So let's get started here. Come on, little buddy. Oh, here we go. Okay. Why are we here, right? So my guess is, and as we've sort of gone over, either people here are either in the process of running a business or assisting folks who are running a business and helping them sort of grow the business where we need to go, right? So in the idea of building a business, right? I mean, if you just break it down to the sheer fundamental of what a business is, it is an exchange of goods or services for money, right? For money is sort of the key, right? This is not a nonprofit. We are here to make money. And so if you can't do that, this is not probably the right place to be, right? There's a cost associating with providing that good and the service. And so being able to manage the cost of it and understanding the cost component and how that reflects on the revenue component of it is really critical in understanding that. We're going to talk a little bit more about that as I go down sort of on the revenue and pricing and things like that. So we'll talk about that. But at the core of this, as I mentioned, you have to be a profitable business, right? I mean, this is the fundamental reason that you lose sleep at night, and the fundamental reason that you pour your heart and soul into something is to build something and ultimately turn it into a sustainable business. And so financial literacy is critically important to that, because being able to sort of articulate your business is unbelievably important, not just from the perspective of sort of being able to understand your business, but as a entrepreneur, as an owner, I say this all the time, you are in a position where you are chronically selling, okay? An owner or a CEO is selling something 24 hours a day. You are either selling your product, you are selling a piece of your business, if you're going to venture capital, you're selling the health and trajectory of your business if you want to go get debt. You're selling your workplace as a place you want to be if you are hiring. You are in a chronic state of selling, and you need to be so fluent in every single aspect of that in order to properly articulate how to sell that, whatever you're selling that day at that moment in time, right? And it doesn't always have to be a direct translation to a financial number. You don't always have to just know this financial metric, but you have to understand the broader assumptions that come with that, right? So again, fluency. Customers don't buy if you're not fluent. Your vendors won't have confidence in you if you're not fluent. Your bank's not going to lend to you if you're not fluent, and your investors won't invest. You ask any investor that's out there, 9 times out of 10, they will tell you that, well, probably 10 times out of 10, they'll tell you that they are actually investing in the owner more than they're investing in the business. Any mediocre owner can run a really great business into the ground. And any great CEO can take a mediocre business and sort of run it better, right? And turn it into a better business. So we are here to help owners become fluent. Okay. So let's go back to sort of the basics, right? I think there was only a handful of you guys that have a really good understanding of accounting basics, right? So I'm just going to brace through this because this is not an accounting 101 course. This is, you guys are probably all going to log off if I spend too much time on this stuff. So I'm not going to do that, but I do want to make sure you understand sort of the very basics, right? So let's peel it all the way back to the basics, right? Accounting 101. Accounting books are booked in a ledger, right? This is called double entry accounting. I think this is why I was attracted to accounting as a student, because I am a very logical, analytical person. Accounting is not art. It is pure science, okay? There's no art to it. It is one debit, one credit, and it all balances. It's beautiful. There's a journal entry for everything. It's very easy, right? Everything will always balance. I mean, 20 plus years of doing this, and I still get out a piece of paper and write journal entries when I'm quite not sure what I'm doing. So understanding that helps you understand just the basics of financial statements. You have a balance sheet, which balances, hence the name balance sheet, right? You have a debit side, you have a credit side. Every journal entry has a debit side and a credit side. Easy, right? The balance sheet is, and we'll go over this a little bit more, it's just a quick snapshot of sort of where your business is, the sort of health of your company at that moment in time. What do you own? What do you owe? And how much of that did you do sort of on your own? That's your equity portion, okay? The income statement, on the other hand, is over a period of time. And an income statement is something that is sort of kind of key to your early stage companies. People care a little bit less about your balance sheet earlier on. Later on, that stuff makes a really big difference. Early on, people really just sort of care about your income statement. So you want to ultimately understand sort of how you run your income statement. There's a lot of slides, just a real quick aside. There's a lot of slides in here that were in my first presentation, and I just sort of kicked them out to the appendix. So they're all still there, and they're sort of detailed, you know, how to run an income statement and sort of assumptions and things like that. So I kept them in there just for folks who didn't have a chance to see the first session. So for those of you who had already seen it and watched it, some of the stuff's going to be repetitive, so hang in there. And then the last financial statement, which we'll talk about also, is just your statement of cash flows, okay? And we'll go over that. And that just tells you uses and sources of cash. Accrual and cash basis. Accrual basis, again, further down the road, it's really important to sort of have an accrual basis of your financial statements. An accrual is just a better alignment of income versus expenses, right? A lot of times, think of how you prepay something, right? Or you lend something to somebody on credit. You purchase it and they do it on credit. Think about your credit card, right? You purchase a bunch of things, you don't pay it till later. So those things are kind of accruals. When you book things on your books, like I'm owed money or I also owe money. Those are accrual basis accounting. Early on, a lot of times people just book things on a cash basis, right? It's just, if I only book an entry when the cash happens, not necessarily when I book the income. So let's say I did some services. We have some service companies here. Let's say I booked some services for December, but you actually didn't pay me till January. On a cash basis, I would just book that in January. You just book according to cash. When cash comes in the door, you book something. When cash goes out the door, you book it. That's your cash basis versus accrual. Accrual just takes a little bit more of, hey, I did services in December, so I want to show it in my December financial statements, even though nobody's given me cash yet, okay? So that's just the difference. It's not a really big difference, particularly early on. You likely don't have a ton of accruals. And so a lot of people just sort of book their stuff on a cash basis early on, and that's okay to do. Ultimately, you're going to need to make your way over to what's considered accrual or GAAP compliant. That's sort of what people want to see. It's a better matching. And then again, back to basics, right? We have our debits and credits, right? I talked about debits and credits. I'm not going to go over this exhaustive list here because I'm guessing most of you guys have a basic understanding. And you'll get a better sense of this when we look at the balance sheet. But you have debits, you have credits. And so it's just a matter of, again, when there is a debit entry, there's also a credit entry. So if you think about something as simple as I sold a product, I created revenues, and somebody paid me cash. I increase my cash, I debit my cash, I increase my revenues, and that's on the credit side, okay? So that's just basic stuff. I threw it in there. If you guys want to go back and have an accounting 101 lesson, we can do another separate session on that. But I threw that in there because I've taught this before, and I've found that sometimes people actually want to go over some of this debits and credit stuff. I can tell by you guys probably don't want to do that. So let's move on. Okay, nitty-gritty, financial statements. So there are 3 primary financial statements. I'm sure you guys have heard of these, or at least seen them in passing. There's a balance sheet, an income statement, and a cash flow. You need to understand all 3 of them, and you need to be able to read all 3 of them in order to best understand what the health of your business is. They are all interrelated, right? So balance sheet, income statement, cash flow. We're going to go over them in detail here. Next, first, balance sheet. We talked about this. This is a snapshot at a period of time. If you read a balance sheet, what you will see is at the top, see here, it says December 31st, 2100. But in any case, what you'll see is usually it says as of December 31st. It's on a particular date. How much cash do I have in my balance, in my account on that day? How much did I owe the bank on that day? How much did my customers owe me on that day? It is a snapshot at a point in time. It is, as we said, balanced. There's your assets. If you look at the bottom of the slide, you see your assets are on one side. The assets is the stuff that I own, something that has value, right? Cash, investments, inventory, fixed assets, computers, real estate, anything that has some tangible asset value is there. On the other side of the equation are your liabilities or your equities. How did you pay for that? How did you get it, right? So think of the simplest example. Let's say you go and buy a car, okay? And let's say it's a $10,000 car. You're not going to get a $10,000 car nowadays, but let's say it's a $10,000 car. You have a $10,000 asset. And let's say you actually went and got a loan for it, for the full amount. You didn't have any cash in your account. Somebody fully financed it. You have a $10,000 car on your balance sheet, and you have a $10,000 liability on your balance sheet. That's how you pay for it. That's your liabilities. Let's say in the same example, let's say you put a $2,000 deposit down on that car, right? $10,000 asset. Now you only have an $8,000 loan. That's your liability, and $2,000 of equity. Equity is sort of like what you put into the business, right? What you put into it. It's either cash out of your personal account or some hard work or income or whatever that is. That all translates into an asset somehow. And that's what equity is, okay? And so the idea of a balance sheet is when you look at a balance sheet, it helps somebody understand the strength of your business. So look at this balance sheet here. We have assets, if you look on the bottom of that, of $472,000 worth of assets, okay? In order to accumulate $472,000 worth of assets, I have $247,000 of liabilities that I use to fund that somehow. $200,000 of that's long-term debt, probably some bank loan that I had taken out. Some people, you know, accounts payable. I owe the utility company, I owe a vendor, whatever those things are. So what you end up having is about $225,000 of equity. Equity just means what's kind of left over. Let's say you were to liquidate your company today and we sold all of your assets for face value. You sold them for $470,000. I paid off all of my liabilities. In theory, you're now going to walk away with $225,000 in your pocket, right? That's sort of what the equity is telling you. That tells me the strength of your company. If you are highly levered, so if you look at my second bullet point here, leverage. Leverage is the idea of borrowing money, okay? You might have heard terms like over-levered, okay? That is a dangerous place to be because don't forget, when you take debt out, it can be very punitive when you default on it. Okay, so think about that car loan, okay? Think about your $10,000 car. And let's say you only borrowed $5,000. that bank that you borrow the $5,000 from has a lien on your entire car. They're not only going to take $5,000, they take your car. Okay. So it can be very punitive. So if I see, if I looked at this balance sheet, and let's say it's $472,000 of assets, but you had $470,000 of liabilities, that is not a sturdy business. That is something that is highly over-levered. That is a company that is at risk of defaulting on debt and therefore losing their assets. Debt can be very, very punitive, okay? Particularly if you take out, like venture debt, things like that. If you were to fund your business with a large piece of debt, you are going to sign a document that basically says, hey, if you miss one payment, I get to take the whole company. Basically what it comes down to. So being highly levered is a very dangerous place to be. I'm not saying don't do it, but it's a dangerous place to be over levered, okay? And so that's what I'm looking at when I look at balance sheets, right? So it helps me understand the strength, longevity of your company. How much cash do you have? How much debt do you have? Are you overburdened with debt? I mean, if you guys think about this back to 2008 when everything crashed, part of it was this, it was over leverage. A lot of companies took on too much debt to pay for these assets, and then the value of these assets sank. Now the bank was like, well, you don't have enough assets to cover my debt. And so they would do a margin call and boom, all of a sudden you're insolvent. You don't have enough to cover that debt. So leverage is really important. So that's kind of what we're looking at when you look at balance sheet. When people say balance sheet strength, that's what they're talking about. How much cash do you have? How much liquid assets do you have? This third bullet point, working capital. How much working capital do you have? Working capital is your company's short-term ability to fund the business. Current assets minus current liabilities. How much cash, inventory, anything you can sell. Current means what within 1 year. So if within 1 year, everybody on your liabilities has to get paid and you have just these 1 year assets to pay, do you have enough working capital to sustain the business? That's what working capital is. Assets in excess of current liabilities. Sometimes you'll see that presented as a ratio, as your current ratio, right? So it's a percentage of assets to liabilities. I have 1 times or 2 times. The bigger the number, the better. You want more assets over the liabilities. If you have 2x the amount of assets to cover current liabilities, that's great. That's what you're looking at, for current, your current ratio. Okay, so that's kind of your basic understanding of a balance sheet, right? So those are the things that I'm looking for when I look at a balance sheet. Strength, working capital, leverage, right? And how close are you to, so think of it this way. Again, we sort of talked about this in the 2008 example, right? So if you have a bunch of assets that are all paid for by debt, and then all of a sudden the value of those assets drop, you now have what's considered negative equity. That's when you become insolvent. So here we go. So you can see just on the balance sheet, we just have sort of the same kind of basic buckets, right? Current assets we talked about, those are your short-term assets. Those are things if I needed to liquidate within a year and I needed liquidity, I needed cash or something, in theory, I should be able to pull down those assets and turn them into cash within 1 year time. So in this case, we have $149,000. If you look on the other side to your current liability side, you have $47,000 of current liabilities. That leaves you $102,000 of working capital. Depending on what your company does and what your income statement looks like, that could be great. That could be tight. I don't know. It depends on what the rhythm of your company is. But you have some working capital, and that's going to be important to understand. What is your working capital? Okay. Assets and liabilities are generally gone. They're generally listed kind of current to long-term. So again, you have current assets, property and equipment, and then other assets. Intangible assets, that's just one of those, can't quite, it's almost like goodwill. It's almost this like a patent maybe. If you have a patent, there's some value in your patent. There's a goodwill bucket, which is almost like a figure, almost a plug figure sometimes. If somebody overpays, not overpays, but if they pay you something and you don't necessarily have a book value for it, that's kind of where it goes. So the intangibles a little bit more of a wonky bucket. Things that are probably less important now. You guys are probably mostly worried about current assets, and then maybe some property and equipment, or what they call PPE, property, plant, and equipment, okay? Liabilities, again, same thing. Current liabilities, long-term debt. What you'll notice is long-term debt is always there, kind of below the current, so that's your long-term debt. But oftentimes you'll carve out the current portion of that and put it up into current liabilities. Again, gives you a better sense of what your working capital is. So balance sheet, okay? At the end of the day, you see it balances. Total assets, 472,100. Total liability, shareholder equity, 472,100. Okay? Simple, simple. Income statement. This is your bottom line. This is the one that everyone cares about, right? This is your profit and loss on a very basic, high level. Revenues minus expenses equal income. Here we go. Here's the format that I use. Revenue, that's just pure money that you're making, not cost associated. Whatever you're charging, however many you've sold, that's your revenue. The cost of sales is that cost associated with it. So I'm selling pens, okay? I sell a pen for $1. The ink, the rubber, the plastic, all of the pieces, the shipping, the boxing, all of that stuff cost me 45 cents, okay? So my revenues would show for $1, cost of sales of 45 cents. That means my gross profit is 55 cents, or better presented is your gross profit percentage, okay? So that's a 55% gross profit. This helps me, your gross profit is important to me, because what I'm going to do is I'm going to compare that to the market, and I'm going to make sure it makes sense. And I've used this example all the time, but let's say you're a services company, because we have a few services guys here. So let's say you're a services company, and let's say you have a 75% gross margin on your services. That sounds great. You are so happy, you're patting yourself on the back. I'm making great money. Let's say you go in the marketplace and it turns out everyone else offering those services actually has an 85% profit margin percentage. So 75 seems good, but what are you doing differently? Why are you at 75 when everybody else should be at 85? Now, businesses are different, I understand that, but there are general market conditions. And so, for instance, if you're in a software company, those margins should be at a certain level. If you are in an education software company, those margins are at a certain level. If you're in a marketing technology company, those margins are at a certain level. If you're in services, there are ranges that are available out there, and you want to be able to stay within them, because then that helps me understand that you understand what the business is supposed to look like. Gross profits change over time. The important thing with gross profits is early on, you might have better gross profits, which kind of seems counterintuitive, but you got to remember early on in a company, oftentimes you're going to spend a lot of time shouldering that burden, right? Maybe if you are selling these pens, maybe I'm boxing them and assembling them in my house myself. So I don't have anybody else in my supply chain that's taking their piece. There's no additional costs in there. So it doesn't always move linearly. It doesn't always move in the way that you always think it should. Okay, so just make sure ultimately when you get to scale that gross profit makes sense according to what it should be, what the market is. If your gross profit is dramatically higher than everyone else's, that's great. But you also need to go back and just make sure you're sort of, is that right? If it is, that's great. That's wonderful. You always want higher gross profits. If it's lower, you really have to assess your business. Why is it lower? What am I doing differently? Are my costs too high? Am I pricing incorrectly? Am I in the wrong market? Maybe whatever that is. But that's a really good indication of whether or not you are in the right zone for what you're doing. So never compare your gross profit to a different industry. Never compare it to a different type of a company. Always find someone that looks very much like you at your stage and figure out what that needs to be. And then at some point, you're going to kind of make your way to what your kind of market gross profit's going to be. Once you reach that gross profit level at scale, you generally stay in that same bucket unless you start changing kind of the model of the business. Okay. So that's what I'm looking for at the gross profit. The next 4 lines, the rent, salary, office, and other expense, those are like operating expenses. Those are just sort of all the other expenses that you're going to take on underneath, okay? Once you expense out all the rest of your other expenses, that's when you get to your net income, okay? That's your punchline. How much money are you making? After you sell your goods, take out the cost of the goods, take out the cost of running the business, what are you making? And there's also another net profit percentage that you do at the bottom. And again, make sure that's in line with market, not necessarily with your neighbor Sally's business, because Sally's probably doing something different than you are. Make sure it makes sense with other businesses. Okay. So we talked a little bit about profitability. I went back to this last slide here. Things that I care about on the income statement as you view them and understand them again, as you become financially literate and fluent in this, you understand that. What I'm looking for is profitability. Not all businesses, particularly early businesses, are going to be profitable, and that's okay. We don't necessarily need them to be profitable. We understand that it takes a lot of money and energy to create a business at scale and one that actually starts to generate money. But do you have a chance to get profitable, right? Do you, and I think I have this in a slide later when we talk about unit economics, is everything that you're selling actually profitable? If I'm selling this pen for $1 and it turns out all of my materials cost me $1.10, I really probably shouldn't be in business, or I should change my price, or I should find new materials. I should sell something else, whatever that is. So you have to be able to boil that down. Profitability is king, right? You need to understand profitability. Is the stuff that you're doing profitable? Because you have to make money in order to sustain the operations of the actual business after that. Margins, we talked about, same sort of thing, right? So how much money are you making on these products? Revenue versus expense alignment. What an income statement also tells me is whether or not you are aligned. If you are only making $200,000 a year, I don't mean to say only, but I live in a venture world, so we look at numbers in a different way. But let's just say you are making, well, let's just say you make $10,000 a year selling goods, right? But let's say you're spending $30,000 a year on travel and miscellaneous and marketing and all of these expenses. I mean, net, it's not a huge number, but comparative to your revenue, it's probably not, it doesn't seem aligned. So are you being judicious about your spend? Are you prudent about where your money is? Are you looking at every expense early on as almost an ROI indicator? Do you look for how you get a return on the cost that you're spending? For instance, if I have a salesperson, which is very expensive and very difficult, if I start hiring a salesperson, is that the right time to hire the salesperson? Are they going to have enough product for them to sell? Do you have enough margin in order to sustain them in the business? Or marketing costs. Are you out printing a bunch of flyers and putting advertisements in Facebook? And are you actually getting a return on your investment, right? Did you go out and rent a huge office space in downtown DC at $70 a square foot and half of it's empty, right? So where's the discipline? Does the expense align with the stage of your company? Does it make sense against your revenue? And then the last line that I'm sort of looking at is your EBITDA, EBITDA. There's a bunch of different ways people pronounce it. This is your earnings before interest, taxes, depreciation, and amortization. That is basically taking your bottom line number and adding back those non-cash items. It is a quick and easy proxy to get to cash flow. Okay, and that's going to be important as we talk about sort of creating your income statement. Oftentimes people use that EBITDA number as a proxy for cash flow, because what that does is it kind of adds back in all of the other non-cash kind of expenses, you know, depreciation, amortization. Taxes is a cash expense, but it's sort of after the business, right? So it's sort of post everything that happens in the business. So we kind of carve that out. And it helps me understand how much money did you really make, right, cash-wise. And that's important, again, as we talk about cash flows. So EBITDA versus net income, a little bit different. Net income is just sort of bottom line. EBITDA sort of takes some of the money back and says, what does that look like? A little bit more on a cash basis. So that's your income statement. Again, this is the one that you guys will focus on the most for early stage companies. This is the one that people want to look at over time. So understanding this, we're going to go through a lot of assumptions on the income statement. I don't have assumptions in here on the balance sheet because, I mean, that's just, you guys are just going to have to, balance sheets are created after you do the income statement. So I want to go over more of the assumptions that you're going to use as you create your income statement. Okay. Do I still have everyone? Perfect. Statement of cash flows. This one again is really important when you're like a large publicly traded company. Early on, you're not really going to be doing cash flows. I spent years as an auditor, and this was like the bane of my existence, was creating people's cash flows. It seems like it should be simple because if your balance sheet balances, your cash flow is supposed to work, but for some reason, it just never, just such a nightmare to do. You luckily, again, you'll use your EBITDA number at the bottom of your income statement as a proxy for cash. So you don't necessarily need to actually create this, but understanding this is important because ultimately you will need to. The good news is when it comes to creating these financial statements, all of them, most of you all are probably going to use a piece of software to do so. And you can just kind of push a button and it spits it all out, and it's lovely and wonderful. But again, my job is to make sure you're fluent in all of the data and all of the assumptions that went in to creating all of that stuff so that you can speak to it as you look at a forward-looking statement. Statement of cash flows just takes basically all, it usually starts with your net income number. Remember, net income is not always just cash. It takes that, adds back and subtracts out all of those non-cash sort of activities and reconciles it back. So at the bottom three lines is the one that's most important. You have your net increase in cash, cash at the beginning of the year, and then cash at the end of the year. They parse it out into three buckets. Okay, cash flow is always parsed out into three buckets. What this cash flow tells me is where is your cash coming from? If you were showing negative cash flow from operating year over year, that means your operating business isn't doing so great, right? The actual meat and potatoes of your business is not doing great. You are losing money. The only reason you're making money maybe is if you have positive cash flow in your financing activities. That means you're just going out raising money. You're getting more debt. You're probably over levered. You're selling a bunch of your company equity pieces, whatever it is. If you have too much inflows on your financing activities and constant negatives on your operating, that is a really hard business. It is not sustainable. Ultimately, that's going to have to switch. And in this case, you see you have a $25,000 cash flow from operating activities, which means just running the business is making you $25,000 a year in cash. Okay, it's generating $25,000 of cash, and $3,000 negative in your financing bucket means that you're paying down your debt. That's a good thing, right? It's getting smaller and smaller. That's what I want to see. That is a healthy cash flow. You have net increase in cash throughout the year, operating activities that are cash flow positive, and financing activities that are negative. Investing activities are just things that don't run through your income statement generally. So capital expenditures are things like I bought a building, I bought a car, I bought furniture, I bought computers. That's what that is, okay? So that shows up as a separate bucket because that's not financing and that's not operating necessarily. You want operating to be just a clear indication of just the business, okay? So that is what your cash flow statement is going to show. Again, less important now, very easy to generate in your software with a push of a button. So it's something I would recommend making sure when you do have a business or your company has a business is one in which you just want to make sure they print it every so often just to make sure things sort of make sense. Okay. Nobody's going to really ask for it right now. Maybe if you go to a bank for a bank loan, they might be more interested in it. But for this case, you don't necessarily need it, especially for early stage startup companies. Okay. Here we go. Now we want to tie it together and create an actual set of financial statements. Again, most software is going to do this for you. It's a beautiful thing. You don't need to get into the nitty gritty. You don't necessarily need to know all the debits and credits. You don't necessarily need to know all of that stuff. But the budgeting and the forecasting, that financial forecast on your income statement that I talked about, is generally done outside of your software program, because you're going to need to put your thought process, your assumptions into it. You're going to need to be able to add sensitivities to it in a good year, bad year, medium year. What happens if this job doesn't close? What happens if this person, what happens if I get this client or don't get this client? Those types of things, you're going to need to just sort of be able to do that. Once you have those numbers, generally you input them into your software, and then you can have like a budget versus actual, and it just shows kind of where you are versus where you thought you would be, which you're always going to be off, and that's okay. None of ours ever hit their targets the way we think they would. And I keep mentioning this. Most important thing is understanding your income statement and presenting an income statement. There are very few companies, particularly if you're out to raise venture capital, that are going to require like a balance sheet if you have one, but they're kind of hard to make because it's hard to sort of assume how much am I going to have in payables? I don't know, right? How much am I going to buy in stuff? I don't know, right? But I can have a general idea of how much I'm going to sell my business, how much operating expense I might have, how many staff I'm going to have, things like that. It's a little bit easier to do that. And again, the cash position, you can kind of plug it onto the bottom of your income statement and sort of reach those two basic things that everyone cares about: profitability, revenues, growth, and cash. Those are the things that I really, really care about. Okay. And that's where you see down here, a good forecast on your income statement will help me understand. Generally, you want to go 3 years out. So it'll show me where, how, and when the growth is coming. And does it make sense, right? Where is it coming from? Is it upsells? Am I changing the price of my product and therefore I have more revenue? Am I selling more product? Do I have more repeat customers? Did I create a new distribution channel? Whatever that is, I should be able to see that in your income statement. And you should be able to articulate where all of that came from. Again, understanding margins. We talked about this already. Really important. Where are your margins compared to other, generally, particularly if you talk to other, probably lenders as well as anybody else that would sort of finance your business, they all have a general idea of where they think your margins should be. So as long as you know where your margins are, where everybody else thinks your margins should be, and how you got to your margins, that's going to be really important. We talked about discipline and spend, understanding. A lot of times we run into things where, this is a bad word, but the vanity sort of can take over, right? So there is a vanity in running and being an entrepreneur. There is a vanity in sort of running a business. There's a little bit of a vanity in saying, I have X amount of employees, or I have office space here, or I have this, or I have that. And so the discipline and spend helps me understand how much you sort of manage some of that, right? Some people go out and hire a bunch of people because all of a sudden you have some money. And then you have people that are kind of sitting on the bench. Well, they just, make sure you're disciplined. Listen, money goes fast, and it's really hard to come by. And in particular right now, very germane to the conversation, it's really, really hard to come by. So understanding that discipline and spend is really, really important. It's the same sort of lesson we learn in personal finance, right? Doesn't matter how much money you make, it matters how much you spend. So it's the same thing in your business too. Be stingy, be greedy, hoard every dollar that you can, and just throw it back into the business. And I promise it'll have much better returns. Cash spend and position, again, we talked about that, using EBITDA as a proxy for cash and having a small cash reconciliation at the end. Generally, what you can do is similar to the way this cash flow was at the end of your income statement on a monthly basis. You can have a beginning of cash, and then you plug in sort of that month's cash flow, and you have your ending cash. And you just have this rolling kind of calculation that goes with it. That just gives you a good understanding of sort of where cash is without having to print out one of these cash flows. And again, 3 years of data. That's kind of bare minimum. You don't need to go much further than that. It's all kind of it's all just assumption written. It's really hard to prove that stuff. But going 3 years out helps me understand how well you understand your business, right? It helps. It's long enough to help me see what the growth actually looks like, what the company's going to look like in time. And that's what I want to see. This is going to look really familiar for you folks who have been part of the first presentation that I did. The purpose of this, again, and I sort of repeat myself a lot because I think it's really, really important to sort of understand this. The purpose of this is to convey the health and trajectory of your business. Again, I keep talking about health. Health of your business is critical. We need to make sure you're not built on a house of cards here, right? And you need to make sure that there is a strong foundation. Do you understand your business? Do you understand your metrics? Do you understand what you're doing? Do you understand your margins? Are you over levered? Did you borrow a whole bunch to get there? Or did you actually make some money and throw it back into the business, right? How sustainable is this as a business? It's really important. Many, many people start businesses, but the majority of them fail for a variety of reasons. Some of them just don't understand the business. Some of them don't understand marketplaces. Some of them don't understand their customers. Maybe it's the wrong time. There's a gazillion reasons that businesses fail. Most businesses have a chance of survival if you take the time to really understand all of those things. And we'll talk a little bit about metrics and sort of assumptions. Before you go through the process, you need to go through these assumptions and make sure you understand them. If you can do that, I promise you have a better chance at this, okay? We've gone over this, a lot of this stuff. The other thing that's going to show up in your income statement is at what point does your company break even, right? So there is a point in time early on that we just assume your business is going to be losing money, particularly in the venture space. Not everyone's going to reach that point. A lot of people can be profitable from the beginning, particularly if you're in a high margin type business, or if you're in a services business and you're the only one providing the services. Oftentimes you can create a fairly profitable business early on. But once you scale, remember I told you it doesn't always move in the way that you think it does. Sometimes it's going to go down way before it goes back up again. So early on, when it's just yourself doing everything, running all of this, you're just running it on the back, on your own back, you can make a fairly profitable business. But a lot of businesses, once you sort of turn that engine on and you want to start to grow, any money and any income that you have, you just throw it back into the business, right? And you need a lot of money to create software if you're doing a software. There's a lot of R&D costs. There's a lot of engineering costs. There's a lot of Q&A, customer discovery. There's just a lot of legwork that needs to go into building a business early on. And so those businesses are going to be in the red, meaning losing cash flow on an annual basis. And that's okay. Those are the types of businesses that venture companies want to fund, right? They don't mind paying. They understand and paying for a business that's losing money, because we understand that all that money is just going back into the business, making a better product, getting a sales force up and running, finding the right pipe, filling the pipeline. All of that thing's important. But at some point in time, I'm going to need to see that company get to cash flow break even. Cash flow break even is the point in time in which your business no longer needs outside capital to survive, okay? And either that's because you've lightened up on R&D, you've got enough margin, you have enough sales that creates enough margin, whatever that is, there's a variety of reasons in which your company will actually reach that break even point. Particularly now in a recession kind of environment with uncertainty in the marketplace, A lot of the companies that are in my portfolio that were all losing money, we are now forcing them to become cash flow break even. And the way you do that is either, mostly you just slash G&A. We were able to sustain a lot of G&A costs early on or throughout this before we got to a point where we're like, you know what, there's probably not any more capital in the market for us to get. And so there are different ways. So the point is there are different ways to get to break even. And you need to understand what levers you can pull in order to get to a break even business. If your product that you are selling is profitable, okay, if you are selling your pen and you're making 10 cents on it, 30 cents on it, whatever it is that you are making, if you have a profitable product, one product, you should be able to run a profitable business. It's the discipline in your spend and understanding sort of how you're going to do that in order to get to break even. Break even is critically important because that shows that you have a business that can sustain. You can only raise money for so long before you need to be able to do it on your own. You need to be an operating entity that makes money. Okay? And again, here's your use of funds and deployment of capital. I care about this as a venture. In the venture world, we care about this because if we're going to give you a big sum of money, or if a bank is going to give you a big sum of money, I want to know where it's going to go. I want to make sure that the money that goes into your bank account is accretive. I want to make sure that there is a return on that. Are you using it to ramp up your sales force? Are you using it to hire more people, engineers, create more product? Or are you just flying first class now, right? Are you going out to dinner more? Where's your money going to go? I want to see where that money's going to go, and that's what's going to show in your financial model. Use of funds, where is that going to go? And ultimately, do you know your business? What's the view of your business, right? Successful modeling, again, are you showing a growing business? It doesn't need to be perfect, okay? And there is what we call a hockey stick, which I think a lot of you guys probably know what that is. It just goes straight up and to the right. Beautiful thing. It'd be great if they all did that, but it rarely does. But you need to sell the dream, okay? So if you are selling to a venture capitalist, if you are looking to raise outside capital, there needs to be a balance between showing a reasonable business versus sort of that hockey stick. Now, if you're only going out and raising debt, let's say you just need a bank loan, an SBA loan, they don't need to see this. They just need to make sure you're making money. They need to make sure you can service their debt. Servicing their debt just means interest payments, principal payments, whatever the agreement is. That's all they really care about. Do you have enough cash flows in order to make sure you guys can service the debt? That's all they really care about. Venture capital, anyone that's buying into your business needs to believe in the dream. They need to see the big hockey stick because they need to make a whole bunch of money later on down the road. So in modeling, this is, you know, I have to balance this because sometimes when I teach this, I teach it to everyone who's raising venture capital. And then there's other folks who are just running businesses, don't necessarily need venture money, don't necessarily want venture money. And so there is a balance there. So you need to know what's part of that spectrum your company needs to be. So again, hockey stick, probably more important than people raising outside capital. Okay, we talked about this a little bit and we sort of talk about what the company looks like in different stages, right? Hold on, I see a question here. Let me take a quick break here. Lindsay, what if the ultimate goal is acquisition, where the startup won't be profitable, but a larger company that acquires it can make it such because of the unique assets? I think this is where unit economics come in, which you mentioned before, but not sure. So agreed. There is the ability, Lindsay, for a company to be purchased when it is not profitable, but it is less likely, depending on the company. Now, listen, if you have notoriety like a Snapchat or an Instagram, something that can bring tons of eyes to the table, tons of customers to the table somehow, even though you're not a profit, even though you're not making money, there is an acquisition strategy. The reality is it's really hard to sell a company that is not a gigantic unicorn that is not making money. If there is a unique asset, so for instance, you're selling a piece of software, you got to think, what are they buying? So if, for instance, you have a piece of software and you think it's a great piece of software that Oracle will want, and they have a sales force to sell it, then what they're buying is that software. They're not necessarily going to buy the company. They might just buy the software. And if they buy the company, they'll value it a little bit differently. Very few companies want to buy companies that aren't making money, at least in some way, or at least without, what's the word, kind of visibility to profitability. Because if it is a company that's losing money, it's really hard to tuck it into their company and saying, well, we're going to lose money for 5 years, but don't worry, we'll make money eventually. So if there is a clear path for an asset to get tucked in, generally these large companies like the Oracles and the Salesforces of the world buy up pieces of software like that. And a lot of times they'll overpay, which is great, but it's because it's filling a need. They can just throw it in the sales guy's back and then they go out and sell it. So profitability is less important for those types of things, but that comes down to secret sauce. Like, how good of a company are you, right? How defensible is what you're doing, right? If you think about it in the federal space, federal businesses, you know, contracting businesses get rolled up all the time, but that's because it's the relationship they have. What contract vehicle do they have that's secret saucy, right? Like they have a contract vehicle that's maybe 3 or 4 years long. One that can create additional work, or one that gets into an agency that they don't have access to. There needs to be secret sauce if you want a non-profitable business to be bought up in an acquisition. 9 out of 10 of the businesses that run through the venture space are actually bought in acquisition versus an IPO. I think that's oftentimes a really big, what's the word? Misconception, right? People think that the exit strategy for venture-backed companies is IPO, but that's less often than just a pure acquisition. Unit economics matter, but they're not going to boil it down. When they come down, when a company does an acquisition, they're not going to boil it down to the unit economics as much, because a unit economic comes down to one unit. They're going to assume that it's, if they're even looking at it, they're going to assume that it's profitable in some way. But they're looking at it a little bit more holistically. Does that kind of answer your question a little bit? Okay, perfect. Great. Okay. Moving on. So, okay, so we talked about this early stage, kind of has lighter G&A, a lot of your own founder legwork, limited revenue, heavy R&D. This is sort of where you have those kind of expenses that come into play. And then you have your growth stage after that. So you have early stage, growth stage. This is where you have what's called product market fit. Product market fit means you have something and you've sold it. So that means there is a market for it. That means whatever you created, here's my pen, somebody likes it. They're going to buy it, right? You've proven that somebody wants to buy it. Now we just need to ramp it up. Is it sales? Is it distribution? Whatever it is. That's what that kind of growth stage is. So those are sort of understanding as you do your model, at what stage do you switch from kind of early stage, then you become a growth stage, and what assumptions do you layer in when you get to the growth stage? And then assumptions, you know, assumptions are, they're hard because they're assumptions, right? Who knows? But the most important thing is when you think about your assumptions, and we're going to jump into assumptions next, is do they actually make sense? Okay, and are they achievable? If your entire business is built on you selling your product to Salesforce, and they're going to go out and tuck it into their software, and you're going to make $1 gazillion, that's kind of really hard for me to sink my teeth into, because number one, it's hard to sell to Salesforce. Number two, they take a really long time. Number three, what happens if that doesn't happen? What else do you have? Do you have anything else in your business? Probably not. So how many assumptions do you have? How achievable they are, okay? And that's what you need to make sure you're understanding. And that's, again, when I was talking about when someone looks at your income statement, they are looking at the numbers, but they are more interested in the assumptions that are driving the numbers. So I need to understand that. Okay, here we go. Top down, bottoms up. Just really quick with this. So early stage companies, you're going to do what's called a bottoms up financial model. You're going to create something bottoms up versus top down. A top down model takes a look at general macro market conditions and says, here's what it is. Here's what I think I'm going to do. And so therefore I'm going to build the business. If I can get 1% of market share in DC, it's going to be this big. And if I can do that, then I need to hire 10 people. And so I'm going to put 10 people in, and I'm going to need office space for those 10 people. And that's kind of how you build it. You have a revenue assumption around a general market condition. Those usually only work for bigger companies that kind of understand it. Usually if you have some product that's already deployed one way, and all you have to do is pick it up and replicate it somewhere else, that's kind of how you build a top-down model. You've already sort of proven that stuff out. It makes a little bit of sense. But it's also a very highly optimistic, you know, it's generally a, here's how big the market is, and here, I'm going to tackle it somehow. And by the way, this whole notion of 1% of market share, I always find it to be really, it's a lot harder to achieve than people think, right? People are always like, oh, it's just 1% of the market. Well, 1% of the market's actually oftentimes fairly hard to do. I feel like I saw a chat come up, but I can't find it here. So if you sent a chat, I apologize. I'll try to find it in a second here. Oh, here we go. Yes, Lisa said assumptions can be difficult with new technologies. You are correct. Lisa, do you want to unmute for a second, and do you want to talk?
You know, I mean, one example I was thinking of is one of the companies that I've been helping is in software, healthcare software technology, and it's a diagnostic, healthcare diagnostic company. Somewhat, it's a little bit more complicated than that, but so the market's only about maybe 5 billion or something, and that market is growing by numbers are somewhere around 7 or 8% per annum. But this company's come up with a totally new technology, and so how do you predict what its growth rate is going to be when you really believe that it's going to supplant the existing technology?
See, that's the really hard part, because you've actually got sort of a double-edged sword, right? So you've got just saying that you're going to supplant the old technology always brings into mind sort of, I start to cringe a little bit when it comes to incumbency, right? Particularly in the healthcare space, is how quickly can people move? How hard is it to move the incumbent? How novel is it what you're doing? Who are you selling to? Are you selling to hospitals? Are you selling to individual doctors or practices? I don't know the answer to that. So a lot of that's just going to be discovery, and you're right. I mean, if it's a brand new technology in a brand new space, you're kind of going to have to come up with your own assumptions.
Well, I don't want to take too much time, everybody else's time, but they do have, they are generating 5 million in revenue because their product is being used in the research and development of like Pfizer and Genentech and places like that. They just want to get to the point where they have a standalone product for their own company. So it has, you know, it has that sort of revenue. You see that growth rate, but they want to go a lot farther and a lot broader with.
Okay. But in the same product, with the same product?
Yes.
Okay.
I mean, there are iterations of it, but.
I mean, I think they probably have a fairly good baseline. I mean, if they've created 5 million in sales and they obviously have product market fit, they know who they're selling to. They also have a cadre of information that is so valuable. So they need to go back and look at who said no and why did they say no, right? Maybe are you selling to the wrong person? Is there a different strategy? Maybe are you selling it bottoms up in an organization? Should you be selling it top down? Is there a new distribution channel for them? Do they need to be talking to somebody different? Is there a different application for this, right? So if you want to expand your business, oftentimes you have to either 1, create a new product, or 2, create a new customer set. So in their case, if they have the one product and they're going to keep it, then they need to look at sort of maybe there's a different customer set out there they need to look at. But that part's just, you know, they just need to go through. They're not as new. If they've got 5 million in sales, they're not as new unless the 5 million is tied up in like one contract. No, that is a little bit harder.
They're 10 years old.
Yeah, so then they've got plenty of data that they should be able to go out and sort of figure out how to sort of grow from there. And a lot of it, you know, being kind of as mature as they are, they should have some data that they can kind of rely back on. They should have enough people that they've talked to. They should have general market kind of conditions. They should know a lot of this stuff at this point, hopefully. Unless they're teetering into whole new territory here. But
Yeah,
if they're just sort of, go ahead.
Well, they're targeting new clients because the 5 million is generated using part of their technology, not all of their technology, and they have a unique product that encompasses all of their technology and a different client base. So, for instance, they want to sell into hospitals. They don't want to just do research for Pfizer.
Gotcha. Yeah. So then they'll just need to start to understand finding a new customer base is hard.
Yeah.
Selling to hospitals is dramatically different than selling into a research organization. Right. You know, the sales cycle is different, the administration is different, the ROI that they kind of generate is different, insurance reimbursement, all of that stuff's very different. So they're going to need to do, particularly if you're going to hospitals, they're going to need to start doing a lot of groundwork and understanding hospitals and the sales cycles in hospitals. I think from that perspective, that's going to be more important. I think if they figure out who they need to talk to at hospitals, how to talk to hospitals, are there particular hospitals you should talk to that are kind of leaders in this space? And then you have a bunch of Me Too hospitals after that. You know, so what's the right strategy? And you would just need to find someone that actually has sold to hospitals and understands that space. If that's where they want to go, they need to spend time understanding their customer here, not their product. That's going to be the challenging part. And that's a hard part in sort of healthcare, I think, oftentimes. Does that help?
Yeah. Yeah. Okay. I can ask you more questions offline sometime. Thank you.
Yeah, sure. No problem. Okay, so again, back to this sort of building top-down, bottoms-up. So we talked about a top-down model. The bottoms-up model is one in which you say, here is my bucket of resources. Here is what I have. Here is my production capacity. Here is how much product I have. Here is whatever that is, right? Here is my existing pipeline. Here are the people I can talk to. This is what I have to work with. How do I build a business from here? That is a little bit more realistic for an early stage company. You take what you have and what can you build from there. That's what's called a bottoms up. So we say, I have the capacity to assemble 100 pens a day. Let me build a business from there. How many pens do I need to sell? How long do I have to do that before I have enough cash in my account to hire another person that can assemble pens? And now we can do 200 pens a day. And then now we can do this. So that's sort of how you build a model from the ground up. You start with the basics. What do I have on hand? Who do I have on hand? What assets? What pipeline? All of that stuff. That's how you build. This is how you're going to build your model for all early stage companies. I always tell you should build it bottoms up. It's much more of a realistic look. A lot of startups that say, hey, I'm going to tackle 1% of a $1 billion industry. That sounds great and everything, but I'm not sure if you actually have the resources to tackle 1% of $1 billion. That's a meaningful company. It's a meaningfully sized company. So make sure you're doing it the right way, bottoms up. Think about what you have and how you sort of explore that. I went through that pen example, but it's the same thing. How much as an owner can you do on your own until you can maybe hire somebody, or if you guys were participating or watched any of that Pitch Dingman stuff, Pitch Dingman, I think it was last week or 2 weeks ago, there was Caroline who did baking her cookies, right? How many cookies can she bake before she needs to get a bigger kitchen or hire someone else to help her? She needs to be able to figure that out, and that's what you layer into your business, okay? And then this next bullet point, does your financial ask jive with your model? This is again on the venture space, right? So this is one again. EBITDA is used as a proxy for cash flow. If you raise money, you need to show me that the amount of money that you need, showing the net negatives in that EBITDA columns, does that tie to the amount of money you're asking for? The reason that's important for you folks that are actually out going to be raising money, The reason that's important is raising capital is a full-time job. I want you to go raise enough money to sustain your business for a bare minimum of 18 months, because it'll take you at least 6 months to raise capital. I need you focused. I can't have you raise 6 months. If you tell me you're going to lose $2 million next year and you're out raising $1 million, you're not even going to get through next year. That's not appealing to me, because now you're going to go back to work for 3 months and then you got to go back out and raise money, and you're not, and that's more time you're not spending on the business. So that stuff's important. Again, if you're raising outside capital, again, no right or wrong model, but does it make sense? And are your assumptions defensible? That is what I care about. Okay. You see some models that are insane. I'm talking about hockey stick, and that's okay, as long as you can defend it. And maybe it is a hockey stick. Who knows? There's a bunch of hockey stick businesses out there. Okay. So let's go back to sort of, as we talked about revenue assumptions and sort of the, oh geez, it's already 2:25. Revenue assumptions here, as you talk about, as you build your model on the revenue side, market awareness. This is, again, something you need to be fluent on. What is your total addressable market? We call it TAM. If you tell me your market is, there's 8 billion people in the world, and so my market is 8 billion people, then you have zero understanding of what your market is. Okay? If you are selling, I'm using examples of people that I've worked with at Maryland. If you are selling women's active wear, then you want to look at the sportswear market, and then you want to pare down the sportswear market into maybe women, or this particular person was doing dance apparel. And so then you have to pare it down. So if you tell me that your total addressable market is the full sporting goods market, kind of, but not exactly. So you need to be able to sort of pare it down. Get me to what your actual total addressable market is, something that you can achieve, okay? Is there a magic TAM? No, there is no magic TAM. Everyone's different. Understanding, that's a question from Lisa. So above 10 billion would be great. If that's your TAM, that'd be lovely. It has to be right. But it also has to be compelling. Now, I say that, again, wearing my venture hat, okay? So as a venture investor, I care. If you tell me the entire market is $50 million, that's not super interesting to me, because you need to gain 100% of market share, and you still only have a $50 million business, which, again, it's a big business, but from a venture perspective, it's a little bit different. If I were a lifestyle business sole proprietor, I just want to create a business that I like. And that business, the TAM is $50 million. That's an attractive business. Even if I get 1% of that, that's still a lifestyle-ish business, right? So it's fine. I can still make some money that way. Anything above $1 billion is great. Whether or not that's your real TAM is sort of what it comes down to. So it's balancing expectations of who the reader is, or who the ultimate acquirer is in some way, versus what's actually real, right? So $10 billion would be great, but is that really your TAM? Like, is that really what you're addressing? If you're saying that's the entire healthcare market, that's great. But healthcare is a gazillion different submarkets. So in what submarket do you operate, and how big is that actual thing? Okay. So it's just sort of managing that. And again, on the venture side of the house, wearing my venture hat, I need a larger TAM in order for it to be interesting. If it's 50 million and there's like 4 people already in the space, it's just not interesting. That's a lot of work to get a small amount of market share. Okay. Understanding that, we talked about this a little bit when Lisa asked her question, incumbency. Part of understanding the market is also understanding the competition. Okay. Who is in the marketplace, and who's the incumbent? Oftentimes, upending an incumbent is so much harder, right? Because behavior is one in which they don't want to change. If it's working well enough, I'm not going to be the guy that changes the Cheerios formula, right? Like, it's working. I'm not changing that. It's the same thing. If you go into an enterprise and say, listen, I built a better mousetrap, that's great and everything. I'm not going to be the one that implements this. I don't care if there is some return profile on this. I am using a Salesforce product. It works. It's integrated. Everybody's used to it. Nobody needs to change anything. If your entire business is built on upending an incumbent, it is a challenging place to be unless you have like super secret sauce or really, really banged it out of the park. Product, you know, whatever it is, if there is some additional feature set or whatever that is, you have to be able to sort of understand that. But incumbency is really difficult. When somebody asks you about your business, they're going to want to know about competition. Okay, you have to really understand competition. Who's really your competitive landscape? If you guys have read that book, you know, they talked about sort of Innovator's Dilemma, right? You ever seen that? They talk about sort of the demise of Kodak and the demise of camera companies. But they were, you know, what they didn't realize were the phone companies were eating their lunch, right? They didn't realize that ultimately the cameras would get upended by your mobile phones, right? So understanding who the real competition is, who's going to eat your lunch, who's already in the space, who's a gorilla in the space that you're not going to be able to get rid of, okay? Market awareness also includes customer behavior. Do you know who your customer is? Lisa asked a really good question about sort of, you know, changing into different customer base. And that's really important. Do you understand who they are and how they behave? And so, you know, understanding how hospitals behave versus sort of research organizations. Who in the hospital do you have to, how do they behave with each other, right? I talked about a Me Too thing. There's a lot of organizations that are never the first one to do something, but they're quick to be like, oh, well, these guys did it, so I'm in. They never want to be the first one to do it. So who do you have to knock down first? Do you understand how that works? Again, all of this stuff gets layered in. It might not equate to a dollar for dollar kind of allocation on your income statement, but to be able to articulate all of this when you present your income statement to somebody is really important. We talk about vitamin versus aspirin. You guys have probably heard this before. It's a matter of, is this a nice to have or do I need to have it, right? What pain point are you solving versus this is a nice to have? That is a different sales cycle. That is a different marketing machine, okay? So understanding what you are and where you lay in that spectrum is going to decide how you sort of, you know, position your company. And then current market conditions, I added this in here just because it's actually really germane right now. We have a lot of companies that are recession proof. A lot of companies are not recession proof. Is there a way? So for instance, education, right? They work in opposition to the recession. So all of a sudden we're looking at, you know, potential, you know, disruption in the marketplace, which usually bears well for online education. So do you understand your business? The only reason I bring this up again is because it is important right now. Starting a business, my husband started his business in 2009. So talk about a wonky time to start a business. But is it a recession-proof type business, or can you make your company recession-proof? Do you understand the market? Right, those are the macro market conditions that you understand, and that's what some of these companies are doing. There are, as they say, never waste a good crisis. Right, there are a lot of companies out there that have some tailwinds in this space right now. Healthcare providers, you know, there are some healthcare tech companies that are doing great in this space. I have a company that does, they print t-shirts and so forth, and they started making masks. I mean, there's different ways that you can position your company. So being flexible and understanding how to do that in your business is important. Distribution channels, another thing you need to think about when you think about your revenue assumptions. I'm going to start zipping through this because I haven't gotten to metrics and I really want to go through those. Distribution channel is just how are you selling your product, right? There's a few different ways. Are you a wholesaler? Do you sell your product to a big distributor who then, so do I sell my, you know, AHA sparkling water here to the wholesaler who then distributes it to all the Safeways, and that's how you get to your, or do I go directly into, you know, Do I go directly into the mom's organic market down the street and say, hey, I have this wonderful seltzer, will you sell it? And that's kind of the retail market, right? I go directly to the retailer. Or do I just create a website and sell it direct to consumer? So those are your different distribution channels. Which distribution channels are you going to stand up? How long does it take to stand up these distribution channels? How much income are you going to get from them? Those are things that you're going to, again, as you create your revenue, you have to be able to articulate what your distribution channels is. What is your strategy? How are you going to get your product out in front of people? In line with that is, how are you selling your product? There's a notion of inside sales versus outside sales. Inside sales is one in which you basically have what's considered like a BDR. We call them a BDR, business development rep. They basically sit inside and cold call a bunch of people. And as soon as they get somebody on the line, or they send a bunch of emails, as soon as they get somebody that responds, they like throw it over their shoulder to an account executive, and the account executive fosters that sale. Those types of businesses are generally SaaS type businesses, software as a service, things that are kind of easy to implement. Doesn't take a whole lot of instruction hand holding. You can do a lot of demos online, things like that. Outside sales is your traditional traveling salesman. He's got a bag. He shows up at your front door. Pharma sales, he's got a bag. He goes out and talks to people. You know, big sales for Salesforce or Oracle's, right? They need to show up and have a face-to-face. These guys like to be sold kind of face-to-face. And they take a long time to sell too. There's also your social selling, free and paid. So think about LinkedIn's, the Facebooks, the Instagrams, the Snapchats, the TikToks of the world. There's a lot of ways to sort of utilize them for free. Anyone can create an account. You can put up content, particularly on LinkedIn or the Facebooks of the world. And then you also have paid ones. This is where conversion and ROAS, your return on ad spend, are important. I'm going to skip that for now because I have slides on metrics that I want to go over. And also understanding how long is your sales cycle. If you're going to show me that all of a sudden you hire a salesperson in October, and then come November, that guy sold $3 million worth of product to an enterprise business, I'm going to tell you that doesn't make sense. Because that tells me, number one, you didn't give him any time to ramp up as a salesperson, to start, you know, making cold calls, to turn into warm calls, to turn into visits. You also probably don't understand the sales cycle. How long is the sales cycle, particularly on an enterprise company? They take a long time to sell. You don't get to walk into Marriott and sell them something the next day. You walk into Marriott and maybe in 9 months, you've actually sold them a piece of software. So when you hire a sales force, it's going to take some time. You have to layer all of these assumptions in, right? So as you think about your revenues and say, hey, I'm going to hire a salesperson, think about how long is it actually going to take for them to make their first sale in order for that to start showing up on your revenue side, okay? Other things to think about: seasonality. Seasonality is just the idea that not everything's a linear line. A lot of times people like to say, oh, I'll just sell, you know, 8 units every single month. Well, I mean, if you're selling retail, you probably have holiday seasons that are higher. If you're selling fitness, it's probably after the holiday season that it's higher. If you're selling, you know, ski suits, it's probably in the fall time. If you're selling, right? So you got to understand. And some of that seasonality also has to do with how your customer behaves, right? So for instance, higher ed, I use this example all the time. A lot of times the budgeting in higher ed is Q2. So if you don't make it into their budget cycle, the idea that somehow you're going to sell them outside of the budget cycle is probably false. So seasonality also includes understanding your customer seasonality, okay? So making sure that that makes sense. Growth, again, how are you growing your business? Are you just adding more customers, or do you have a new product set, right? Or are you just upselling your customers? How, you know, so where is that growth coming from? Is it organic? Is it, you know, where is that growth coming from? Help me understand. Is it just more products? If it's more products, then who? Did you open a new distribution channel, right? Do you have a new relationship with a vendor? Or do you assume that after 3 months of using something, people are all going to start paying for it now? Maybe you have a freemium model or something. Help me understand the growth and how you get there. Pricing, we talked a little bit about sort of market compatibility on the margin side. There has to be some market compatibility on the pricing side as well, understanding whether or not you're in line with the market. Now, it is not always a race to the bottom. I say this every single time I teach something like this, because oftentimes we are trained and conditioned to believe that we need to beat somebody on price, but you don't. There is a luxury market for a reason, and it thrives. Okay, that's the same thing for software. That's the same thing for services. If you can provide a better service or a better product, people will pay for it. If your product is better and nicer and newer or whatever it is, you can charge more for it. Okay. Now, if it's hard to, again, you've got an incumbent in the marketplace, it might be difficult to do that, but you also just sort of want to make sure you are not pricing yourself out of the market. Okay. So where's the market compatibility on that? Churn is the same thing as return. So if you think about a return from a product perspective, I'm selling these pens, and on average for every 100 pens that I sell, 3 of them get sent back to me for a variety of reasons. This is the wrong color, I don't like the way it feels, I don't like the way it writes, whatever it is, they get sent back to me. So I have a 3% return rate. We'll just call it that. Churn is the same thing, but on the software side. So if you think about sort of paying for Netflix or Hulu or whatever that is, you are paying on a monthly basis. A lot of people stop paying. Once you stop paying, that's what's considered your churn. If your customer stops paying you for a service that they have been paying for, they have churned off of your software. Churn is an important metric, because I don't care how many people come in to pay, if they all churn off, that's not a really sustainable business. Churn needs to stay low. Same with returns. Returns need to stay low. You want them to stay low. If your churns or returns or things like that are high, you need to understand it. Why are people churning off? There are quick and easy ways to gather that information. If your customers are churning off, you know, like for instance, when you unsubscribe from newspapers or unsubscribe from whatever shows up in your inbox, it always asks you very quickly, very frictionless. Why did you do it? Too many emails. I'm not interested, whatever that is. That information is gathered for them to understand how they understand their churn. So there are things that you can do in order to make sure you understand that. We talked a little bit about defensibility. Talked a little bit about your secret sauce. Secret sauce is just the words that we use to say, what are you doing that makes you better, more defensible, that makes people want to buy you instead of the competitor. And then the other one is why you, why now? Okay, so there's a why you, why now is important because, so for instance, let's say you're doing a product. I'm trying to think of what was kind of germane or now or anything or wasn't. You know, let's say all of a sudden you're doing like a bunch of blockchain ICO type stuff, right? But let's say you did that 6 years ago before anybody even knew anything about it. That's not, timing is off. It might be a really great piece of software, but nobody understood it and there was no application for it. Or what if you're right now selling wall phones with a cord on it, right? Like nobody's going to buy that because my kids don't even know what a landline is. So those types of things. Why you, why now? I know they're weird, antiquated sort of examples, but I'm trying to think off the fly here. So think about what's relevant. Why you, why now? Is it germane to the time? Are people willing to buy it now? Is this the right time? That's as important as is it the right product? Is it the right time to sell what you want to sell? Okay. Expense assumptions. I think we talked a bit about this. The biggest thing I want to make sure you understand here is hiring people is a process that you cannot turn back from, okay? Hiring people is more than just paying them a salary. It is paying them benefits. It is filing your taxes. It is compliance. It's withholdings. It's tax returns. It's paying people to do all of that stuff for you. It's having the HR administrator, having a payroll administrator, having someone to make sure he's not yelling at the employee next to him, having options possibly or equity allocations for them, and then hiring legal firms in order to put that all together. So before you start hiring people, make sure you actually need them at that point in time. There is a ton of stuff that comes with hiring people, a ton of stuff. And so you can't really turn back from that. Once you start filing and become, get into this compliance machine with the IRS and the state and local and federal and all of that stuff, you're just never going to get off of it. So just think about that when you start thinking about hiring somebody. There are ways you can do work on a contract basis if there's some contracting work you want to get done, or just different ways that you can sort of handle that. So think about that. That's the most important thing kind of on the expense side. Okay. We've talked a lot about this, and I just want to kind of zip on here. The defensibility of your assumptions. We talked about this, how defensible are they? And does your company fall apart if your assumptions fall apart? What strategies have you implemented to achieve? Okay, so how have you made sure you would mitigate the risk around these assumptions? Those are the things you need to think about as you create these assumptions. Metrics. I'm going to spend sort of the rest of the time here on the metrics, because I think these are really important, and this is part of the vernacular I think is really important for everyone to kind of understand. So metrics, again, they're not necessarily present in your actual model, but all of these are underlying pieces of information that you're going to need for your model. Okay, so first thing is AOV, your average order volume. This has a lot to do with if you're selling e-com, right? So if you're selling a product online, what is your average order volume? So if I go on your website, how many things do I buy? If I buy on average 5 pens the first time I buy, then my average order volume is $5, right? That's important to know because it relates to what we call our, if you kind of skip down here to your CAC, your CAC, that's your customer acquisition cost. So if you have your customer acquisition cost, that is the fully loaded cost to get one new customer on your platform. Getting a new customer is very expensive. That's why you'll see every time you buy a product, you get a gazillion emails from them, because getting an existing customer to repurchase a product is much cheaper than getting a brand new customer. Because a brand new customer, you need to create some brand awareness somehow. There's a lot of sort of marketing that goes into that. And so the customer acquisition cost is the cost, total cost, fully loaded marketing costs over a period of time, your marketing and sales costs over a period of time, divided by the number of new customers that you receive. So if your customer acquisition cost is $30 and I buy 5 pens, okay? And let's say I do that twice, okay? So I buy 10 pens, that's $10. Let's say on that $10, I made 6 of it in profit, okay? It costs you $30 to get me to buy these 10 pens, and you only made $6 from me. That is not a sustainable business. This is what I talk about when you have to understand these metrics and the fluency that's required in order to understand whether or not you have a sustainable business. So your customer acquisition costs at all times must be lower than what we call the lifetime value of your customer. The lifetime value is how much margin does somebody bring. So we talked about these pens. Your average customer shows up, buys 5 pens, and they do it twice. So your average customer shows up, buys 10 pens. That means my margin is $6. We just said it was $6 for margin. That means for every customer, you make $6. That means it better cost you less than $6 to get me into the sales cycle, okay? That is how you sort of manage these things. If your lifetime value is lower than your customer acquisition cost, boy, you are toast. Because every time you get a new customer in there, it is going to cost you money. You are not making money on this person. Now, the best way to decrease that customer acquisition cost is repeat buyers, right? It's on the software side, making sure they buy for a long period of time. This is relevant, the lifetime value and the customer acquisition cost, this is relevant on the software side as well, okay? So let's say an average customer stays on board for 1 year before they churn off. Remember we talked about churn. They stay on for 1 year and then they churn. Let's say they bring a margin of $100 over that year. As long as your customer acquisition cost to get that person on board is less than $100, then we're okay. But if it costs me $110 to get that customer, it is not okay. You do not have a sustainable business, okay? The only way you can fix that is either you need that customer to stay on longer, you need them to stay on board longer than 12 months, right? Or you need to raise the price somehow, get more margin out of them. So there are ways that you can fix that, but unless you know it, you won't know how to fix it. And this is one of those things where unless you actually go through these metrics, you're never going to understand this just looking at your financial statements. This is something that's completely off your financials. So you have to understand this stuff in order to say, how come I keep bleeding money? How come I'm not making money? You got to go back and look at this and say, that's why I'm not making money. How do I fix that? If you can fix these metrics, these little metrics off of your financial statements, the health of your entire business is going to go up. The average order volume, again, that is, think about the grocery store, right? They have that sort of impulse buy section right when you're standing there. Those are little ways in which to get your order volume up, right? Every time you show up, then your kid wants a Twix bar or whatever, and then you buy this, and oh, actually I'm thirsty, so I'll get this, and oh, look at this great, magazine, and they have a really cool article. And so those are little things that they do. Same thing you can do sort of on your website too if you're selling products, right? Like small little products. You can't really do that, but there are ways in which you can sort of work to try to get your average order volume up. Some of that's just sort of how you position your website, how you set it up. But you want to get your average order volume as high as possible. You want to bring them back in the funnel so your lifetime value gets as high as possible. And you want to keep that customer acquisition cost down. Again, the key to keeping a low customer acquisition cost is repeat, 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 repeat. You want them to come back into the cycle without you having to teach them brand awareness again, having to show them anything. They've already done, they've already purchased, they know what it is, they just came in to buy something else. If you are selling seltzers, and this is the only flavor I have, this is the only seltzer I have. Actually, no, that's not a great idea. We'll stick with my pens. If this is the only pen that I have a limited customer base, I have a limited product base. It's going to be really hard to get people to come back and buy it. Because as long as I have ink in this pen, I'm probably just going to keep using it. I have to wait until this dies. But now if I made a red pen and a highlighter and a pencil, something else, that's how you sort of keep customers back in the funnel. So you always want to think about how do you get customers back into your funnel over and over again. That is the only way you're going to keep that cost down. More metrics. This one's important too. The payback period. The payback period is how long does it take to get so how that formula we talked about here, the lifetime value having to be greater than your CAC. How long does it take for that lifetime value to cover your CAC? Okay, and that's important to know because if, for instance, let's say it costs $10 to get a customer in your pipeline, and let's say you make $2 off of the customer every month. It's a service, okay? So we make $2 in margin. It takes 5 months to get my money back. That's actually a pretty good payback period, okay? Not bad. If I made 50 cents on the customer every single month, it's gonna take me 4 times as long to get that money back. So it's going to take, I don't remember what my original number was, $10 or whatever. So call it 20 months for me to get it back. I'm going to get it back as long as my customer, if my customer stays on board for 24 months, I'm going to get that money back. But it takes me so long to get that back. If you explode that into big numbers, that's a capital intensive business. That means I have to spend a whole lot of money if you're talking about sort of larger scale things. So let's say it costs me $10,000 or whatever that number is. It takes a lot longer to make my money back, which means I'm going to need to take a lot of money in before I get it all back. So long payback periods indicate a capital intensive business. So understanding your payback period, and again, market compatibility is going to be really important, okay? Gross margins, net margins, we talked about this already, so I'm not going to dig in on this too much. Unit economics, again, fundamental, fundamental. did you make money on every single unit that you sold, right? So is the revenue that you made on my pen, if this pen is $1 and all of my products, all of the little pieces, including shipping and fulfillment and all of those things that it takes to sell this pen back, as long as this is smaller, right? So you think of this as on this pen particular, as long as I'm still making money on this, I have a shot to make a profitable business, right? That's kind of what it comes down to. If every single unit, and it seems basic, right? It seems like everybody should know that. And that's because I'm using a really simple example here. But oftentimes it's really hard to tell if you're selling a piece of software or if you've got a bunch of services and maybe there's a few extra hours here, you don't quite realize it. You can't always tell. And so there's always kind of like loaded costs in there. Sometimes it's hard to tell. So you need to be able to sort of pare back, what is it that I'm selling? And if I pare it back to one month of sales or whatever that number, whatever that unit is, whatever the one is, did you actually make money on that? If you didn't, you need to reassess your cost structure, your price point, whatever that is. You just need to make sure it makes sense. Churn, we talked about churn. Again, this is the percentage of customers that stop paying you. This is mostly on the services SaaS side. This is sort of, there's not churn on a product side. They just don't show up again. They mostly gauge kind of repeat buyers, okay? Again, if this is high, remember, every new customer is always much more expensive than a repeat customer. So with a high churn, you're gonna have a hard time recovering your CAC. You'll probably have a longer payback period if you get to that at all. And it's just gonna be a really expensive endeavor. It's sort of the same thing. It doesn't matter how many people you put in the top of the sales funnel, if they all sort of fall out at the bottom, it's a non-sustainable business. Conversion. There's a bunch of conversion ratios. These things are important when you think about sort of the marketing spend that you have, marketing and sales spend, right? Conversion, again, in the broadest sense, means the percentage of customers you can get to achieve a desired goal. So the conversion on email, so an email campaign, how many people click through? What's your conversion rate? Your website visitors versus sales, right? So if you think about the full conversion funnel, you want to think about, okay, so if I send out 100 emails, 10 people open the email, which is, by the way, a really good conversion rate. So let's say I send out 100 emails, 10 people open the email. Of the 10 people that open emails, 5 of them click onto the website. Of the 5 people that show up on the website, 3 of them put something in the cart. And of the 3 of them put something in the cart, 1 of them buys it. So when you go through the full conversion cycle, what you see is for your email, you have conversion all the way through. You go from, I need to send out 100 emails to sell 1 customer. So you see how the conversion is really important. So you always think about ways in which you can sort of increase that conversion rate, right? You want to make that 100 emails that you send out the most effective 100 emails. So how do you increase the content or make it more engaging so there are more people that click through? So instead of having 10 people click through, now we get 20 people to click through. How do you get 10 more people to click through, right? Because you already know that you have a conversion. Once they click through that, then half of them tend to click into the website. Once you get on the website, half of them add to the cart. And then half of those people disappear. Well, then now you have a retarget. Now you have the ability to go back. There's a lot of marketing tools out there where, for instance, if you abandon your cart online, you probably get an email from them that says, hey, you remember this? You want this? They have all of these mechanisms in place. This is all in order to get the conversion metrics better. Because again, it is much cheaper to get you back in that funnel and go and buy what you've already gone through 5 of those steps that I wanted you to go through. So we've already gone through that. Now I just need you to go and finish that last process. So how am I going to push you over the edge there? And that's sort of how they do that. So you'll see a lot of these emails, retargeting. All of a sudden you'll get a random email that says, hey, look at these great items. And you're like, hey, these are ones that I actually clicked on before. It's because, they have all of that data for you. So increasing conversion is really, really cheap and easy way to increase engagement with your customers, increase sales, all of that stuff. All of those things look and sound great, and that's what you want. So that's your conversion. Return on ad spend, ROAS. This one's a little bit harder. Online ad spend is really expensive, and you could get lost spending thousands of dollars and you're not quite sure, was it sort of worth it or not? General ROAS is how much money are you making based on the amount that you spend. So the formula being, you know, sort of return over the spend. So your return profile over your spend. A lot of people think, hey, if I spend $100 and then I sold $100 worth of product, and then I've made my money back on my ad. The reality is on ROAS, the way at least we sort of look at it through our lens, ROAS should be at least a 3x. That means if I spend $100 on ad spend, you should be making $300 on sales. That's generally a baseline of what we consider a decent ROAS. If you only return $100, you spend $100 and only return 100, I mean, it's not terrible. You're not losing money, but you're not making any money either. Okay. So you want to make sure, again, you are judiciously spending your money in the right way. ARR and MRR. ARR is your annual recurring revenue. This is on the software services side. So if you have a monthly amount that you are billing, then you have what's called your monthly recurring revenue. So I have 10 customers. They all pay me $10 a month. That's great. So I have $100 monthly recurring revenue. So my MRR is $100. Okay. The annual one is just sort of an annual rate. So generally, the monthly one is a quicker kind of conversion rate. So it's quicker to sort. It's a little bit of a better indication of what's the word? It's a little bit of a better indication of your recurring revenue because most subscriptions are less than a year. And so you want to use that monthly rate because it usually fluctuates very quickly. With subscriptions that are less than a year, they tend to be a lot more churn, obviously, in that sort of monthly versus your annual, right? Your annual, you have somebody for 12 months and then maybe they churn or maybe they don't. But that's sort of just a way to sort of measure. A lot of times, because of the way accounting works and because of sort of sometimes, you know, let's say I don't start selling my product till September, my income statement might show, you know, only 3 months worth of sales. But if I look at my monthly recurring revenue, my run rate's much higher because in December I have 500 customers, whereas in September I had 0 customers. So, you know, MRR is a better indication of forward looking. What do I think is going to happen sort of in the future here? See a couple of chats here and I think we're getting down. Perfect. So I know people are popping off here. So let me see if I can just run through the rest of this. Oh, and that's the end of that. So I still have a few minutes if anybody has any questions. I'm sorry that I kind of roared through this, but I tend to be kind of chatty. The appendix here, if you'll see, and I'll send this over to or I'll send this to you if you can send this along to everybody.
Absolutely.
Perfect.
Thank you so much.
Sure. And so the appendix here just has some of the slides that I used in the first one. Some of them are pretty basic, just formulaic things you can think about. And then it had, you know, additional assumptions. How do you sort of think about how you layer all of this stuff into your model? And then I even broke it down a little bit more to software and SaaS. So here are some assumptions you need to think about on the software SaaS side. You know, what's the length of your subscriptions? You know, is it a freemium model, auto renew, things like that. So there's lots of different things you can do. And then on the G&A side. So these are just some of the slides that I had. And then this is just a presentation. So if you have a deck that you need to put together, this is just a general idea of how you want that deck to sort of look. Okay. So I have a few minutes if anybody has any questions. You know, you're welcome to drop off. I appreciate you guys taking the time to sit and listen to me blabber on. I hate doing this, not hate. I wish I could do this sort of in person because I feel like it's a little bit more interactive as opposed to me just sort of talking to you guys. But I see there's a few folks left here. So if anybody has any questions, I'm happy to sort of answer them. Otherwise, we can sign off and I can send over the deck. I'll send over the deck, and she has my contact information. So if anybody has any questions, feel free to reach out to me. And Lisa, if you have any additional questions you want to talk about offline too, I'm happy to do that as well. So feel free to shoot me a note and let me know. Okay.
Thank you. That's really nice of you.
Sure.
Yeah, thank you so much.
Sure. Okay. Lindsay, you had a question on unit economics versus margins. Do you want to unmute and let's talk about that?
Yeah, thanks. I'm just looking back through some old decks that I've seen. We have an investment fund in our office, and so I've been trying to pull up examples to look at to refer back. And one, there's a product that they say labor, COGS. It costs us, let's say, $30 to make it, and we can sell it for $100. But then I go to their P&L, and I would expect to see that they would have. I would expect to see that same kind of margin in their P&L, but I don't really see that. And so I didn't know if maybe there's some other component or how are those two things connected? Are they looking at it at slightly different perspectives, or is this maybe just a mismatch?
Well, this is where it gets a little bit, so I'm guessing that on their financial statements, the margins are smaller. And generally it does that because sometimes you can, people generally move sales costs, direct sales costs. So that COGS bucket, sometimes if you go across industries, people treat them differently. So very specifically on this pen example, I know that it cost me, in the materials alone, 50 cents or whatever the example was, and it cost me $1, right? So let's just say I have 50% margins. But there is shipping costs that I didn't put into this when I ship it out. There is a salesperson. There is fulfillment. Let's say now I go to Amazon and they fulfill it for me. So now there's fulfillment costs in there. The COGS line on your financial statements oftentimes tucks in additional costs that they can associate directly with the sale of the unit that might not necessarily be indicative of what the actual unit economic on this particular pen is. So the unit economic is more just on the actual unit itself versus all the additional costs. So you got to think, on the P&L, you also have to layer in returns and costs with that, and breakage and spoilage and theft and, all sorts of other things, right? So it's likely going to be it's likely going to be a smaller margin on your financial statements. Plus they look at it sort of holistically too. Does that kind of answer your question there? Does that help?
Yeah, and I guess a follow-up would be, if you look at the financial statement and the margins aren't really great there, that's still, you said, that's not great. So, right. So even if their unit economics look good.
Yeah, then their cost structure might be off, right? It also could be that they're loading too much stuff in COGS. Maybe it's just a classification issue on their income statement too. That could be one. I would go back and look at what's in COGS, have them peel out everything that's in COGS and make sure you understand it. And then you would probably need to go line by line. Sometimes you're just, the peril of this sometimes is you just get caught in that, well, this is the way we've always done it type situation. And also sort of on that side too, as far as I've always paid $4 for this product. Well, maybe nowadays everyone's only paying $2 for the product. You just don't realize it, right? Sometimes taking a fresh look at the actual cost structure and putting some discipline around that can yield a little bit more that you just didn't even realize that you had. And it's just a matter of understanding it and going kind of line by line. So I would have them, number one, break down what's in their COGS. Number two, make sure they're actually COGS, right? Does it actually align directly with the sale of that unit? And then as long as they're all supposed to be there, then I would look at them line by line. How is this compared to the market? How long have we been paying for this, right? Is there a better distributor? Do we need to go find someone else to produce this product, right? Sometimes you just get caught in a bad contract. You just don't realize it. So understanding that stuff is probably the best thing you can do to help them kind of work on those margins. And, look at sort of comps. If you have comps in the marketplace, to figure out, what are the margins, what should be the margins, whatever it is that they're selling. See if there's some way to figure that out. The best way to find that stuff, although it's not always apples to apples, is you can always look at publicly traded companies that sell similar products. That's the best way, because all of their information is readily available. And so you could go there and see, just to get an idea of sort of what that looks like.
Yeah,
does that help?
Yeah.
Okay, perfect. Looks like there's only a few of us left here. Does anybody else have any questions? I'm happy to sort of open up for anything. I've got some more time here, so I was just kind of rushing to get through. If there's anything I went through quickly and you guys want to talk about it, or anything else you have any questions on, even something I didn't cover, I'm happy to cover it. So let me know.
Well, this is sort of a self-serving question. I'm sorry, I hope you don't mind.
Not at all.
But how do venture capitalists look at sort of advisors helping entrepreneurs raise funds? Is that looked down upon? Because there seems to be a real controversy, like the CEOs, the founders should do it all by themselves, or, yes, it's a full-time job. They need to pay attention to their business too. So it's not a bad idea to hire people.
It's not a bad idea. It depends. So, okay, so there's two things there that I think we need to address. Number one is, you said advisor. So in my capacity, the way I thought about it was, someone who's a board of advisor type, or an advisory position of a company, someone who is doing it because they believe in the company or believe in the CEO, and leveraging your contacts to go out and sort of talk to somebody. When you say hire, then that sort of sets off a little bit more in the way we think about things, which is, if you are out raising capital, again, I told you 10 out of 10 venture capitalists will tell you we are funding into the CEO. So I need to look at the CEO. I need that CEO to look at me. I need to have a conversation with them. I need to believe that they believe in the company. I need to believe that they know everything. I need to believe that they're fluent. I need to understand all of that. So while there is some introductory work that can be done from an advisory perspective, that should be a pretty limited space. It should just be listen, I'm working with this company to help them. Now, if you have a contract from an advisory perspective that you're getting paid for your services over a period of time, that's one thing. If you have a contract that says, I am only getting paid in order to help you raise capital, that does get frowned upon a little bit, just because, again, the CEO should just sort of be out doing this stuff. We kind of need the CEO out doing that. Usually when a CEO hires somebody to help them raise capital, it's a banker. And that's generally a little bit more accepted. The advisor is not unaccepted, it's fine, but I think your role just needs to be one of an introductory nature, and one that is, at least the way we look at it is, maybe if you are the one making the introduction, maybe you show up to the first meeting, and then after that it needs to be kind of between the investor and the CEO. So it is that straight line connection to the CEO that's critically important.
Right.
And so when there's an advisor that sort of acts as a buffer, it makes us think, well, maybe the CEO just doesn't want to work with us, or not, just saying that, just sometimes how it comes across.
No, I guess I act in the capacity of a banker.
Okay, which is